Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is John Katsonas, Managing Partner at Breakwave Advisors. We are talking about the shipping industry and the Breakwave Dry Bulk Shipping ETF, ticker symbol BDRY, which is the best performing ETF year to date. It is up more than 225%. John, welcome to the show.
Thank you very much for having me.
So I noticed that you have been associated with the shipping industry for a long time, more than 20 years. So let's start with your background and your association with this industry.
Yeah, obviously, in today's world, when you talk about ocean-going shipping, is not really the most attractive or popular industry to be in for various reasons. But it's something that when I started my career was very attractive to me in terms of the history of shipping. I mean, if you go back decades or centuries, it is a vital industry to the global economy and something that I would say the Western world doesn't pay a lot of attention to. If you look at the Asian economies and the Asia, growth, shipping has been vital when you talk about trade, when you talk about economic growth, when you talk about infrastructure, construction, and so on. Obviously, China has been a major driver of economic growth, and without shipping, China would not be where they are today. So it is something that attracts me a lot. It has to do a lot with commodities, a lot of dynamic movements in rates, and that's something that is a great characteristic of global shipping. And it's something that interests me a lot, especially in the last few years.
Very interesting. So in late March, for about a week, the world was fixated on a giant ship, which was blocking the Suez Canal and causing massive disruptions in global trade. So we'll talk about that ever-given saga in a bit. But before that, I wanted to start with the importance of Suez Canal, which connects markets from Europe to Asia. So talk to us about the importance of that canal in global trade.
Yeah, obviously, as you look at the world, there are certain points around the globe that affect global trade. One of them is the Suez. Obviously, the Panama Canal is another one. You talk about the Hormuz Straits, you talk about the Singapore Straits. All these are very important, I would say, choke points in the global trade markets. And obviously, the event in March with the blockage of the Suez Canal took a lot of publicity. To be honest, from time to time, you do get these events, and most of the media doesn't report on that. It's amazing that this was reported. I think it has to do a lot with the speed of information now and the social media, and obviously all the pictures and videos that came out. But as you look back, obviously that lasted probably a week or so. It wasn't really meaningful. If you go back way back in the 60s and the 70s, the Suez Canal closed for years back then and caused obviously oil prices to spike and so on. So that was a much more meaningful event. But again, the world operates in increasing speeds today. When you order something online and it has to be delivered at a certain point, you have to make sure that the logistics chain works, and anything that disrupts that is a major disruption for everyone involved, especially following the pandemic. So I think, the publicity had to do with that. But again, these global choke points are very important even today, and is something that you definitely want to pay attention to, whether that's crude oil or containers that move clothes and iPhones and so on, or even dry bulk goods like coal and iron ore, which are not really the most sexy commodities out there, but they're very important for the global economy.
Right, now let's talk about that event a little bit more. The Ever Given, which is a giant ship owned by Taiwan-based Evergreen Group. Tell us how it got stuck, what it was carrying, how it was freed, and where is it now?
I think ships are getting bigger and bigger nowadays, and it has to do with improved technology, obviously. Now we can build bigger ships with stronger materials, and that saves a lot of money for the shippers, right? So the Ever Given is one of the biggest ships around today. And, the Suez Canal or all these choke points have not really caught up in terms of like the expansion in the size of the ships. So, 20 years ago, smaller ships would go through the canal, and even if they had some issue, they could pull them on the side and the canal can continue to operate. With the ship the size of the Ever Given is kind of like very difficult to do so. So I think like it was a combination of like the size of the vessel plus the very specific way that it was stuck. I'm pretty sure a lot of people have seen the pictures. But at the end of the day, these events tend to last days now. Nowadays, you do have the ability to fix that, and it was fixed relatively, I would say, quickly, based on the size of the vessel. Obviously, there was disruption that had a lot of impact on the global shipping supply chain, from freight rates going higher to obviously delays in delivering certain goods and so on. But the whole incident was normalized after a week that the vessel was freed, and obviously everything's back to normal.
So you mentioned that ships have been getting bigger and bigger, and the Ever Given, which is not the largest ship, it is one of the largest. It is longer than the Empire State Building. And I read that for decades now, shipping lines have been making bigger and bigger vessels, which have in general been contributing to logistical bottlenecks. So tell us why ships have become so big.
It all has to do with economies of scale. I mean, it takes almost the same amount of fuel, maybe a little bit more, but not meaningfully more, to move a bigger ship than a smaller ship. If you can carry more cargo, you need the same amount of crew. It makes more sense to build it as bigger as you can. There is a limitation, actually, and the limitation has to do with the engineering of the ships. So I think that, again, famous last words, but probably we're reaching the high-end point of like how big these ships can go. Keep in mind that they have to go to the open seas where you have big storms, and there is an issue with like potentially the ships breaking up. You cannot be longer than a certain amount, and obviously these ships are becoming wider than longer, to be honest. But nautical engineers pay attention to these things, and you also need significant improvement in the materials, the construction materials, to make it even bigger. So I think, like, again, can they go bigger? Probably, but I think like the advances in size that we've seen in the last decade or so. I mean, if you go back in the late 2000s, I would say that a 12,000 TEU ship, basically a ship that can move 12,000 boxes at any given time, was considered a giant ship. Today you have ships that move double that amount. But I would be surprised if 10 years from now we have a ship that moves double that amount, like 50,000 boxes. I don't think that's something that most of the industry expects.
That makes sense. So this event obviously caused a lot of disruptions But container shipping rates have actually been going up. They have been soaring over the past year. And I read in the Financial Times that container shipping rates have more than tripled over the past year. And that is mainly due to supply chain disruptions, which were caused by the pandemic. And of course, the blocking of Suez Canal by the Ever Given further aggravated this problem. So tell us how the pandemic affected global shipping and why shipping rates soared over the past year?
Yeah, I mean, I think that's a great question. And I think probably last year, in the summer of last year, very few people would have think that a scenario like that would play out like what we're experiencing today. But basically, prior to the pandemic, the shipping industry, it was a significant part of the logistical chain, right? So you order a piece of machinery in China, there is a regular schedule that is going to go and pick it up, let's say in Shanghai, and deliver it in Amsterdam. You know the time, you know more or less what you're going to pay. There was a very well-oiled logistical machine that would work, and a full container box will leave China, arrive in Europe, and then the same box have to circulate back to Asia, probably empty. And, you load something, a new product to it. And, this is basically the supply chain in terms of the container shipping. And the same thing goes for dry bulk, right? When you move, let's say, cement from point A to point B, there is a schedule, there is a very well defined timeline and so on. But what happened with the pandemic is that for months, right, very few things were moving around the globe. Reason being that demand for a lot of goods was not there. Factories were shut down, and people were not buying clothes. They were not buying, basic goods that prior to the pandemic they've been used. Suddenly, the world comes to the realization that, okay, we're very close to reopening, especially in the Western world. And suddenly everybody goes out and buys the same stuff. Now you have an issue because you have to ship a much greater quantity of goods in the same period of time. So suddenly all these container boxes and all the industrial goods, it's not only containers, it could be grains, for example, it could be construction materials, steel. All these goods are leaving at the same time their ports of origin or production to the area of consumption. And it happens to be, this is basically the eastern part of the world and the western part of the world. So you have basically all these materials, all these goods being shipped from Asia to Europe at the same time. And this probably was happening late last year. But it continues today. The problem is that you don't have enough time to circulate, whether that's container boxes or ships, fast enough back to the origin to reload. What that means is that prices go up, because if you need to ship something and there is a limited capacity to do so, because everything has already moved at the same time from point A to point B, whoever is left with capacity is going to basically move prices higher. It's going to push for a higher price. And that's what's happening today in the world of shipping. And this is happening mainly in container ships and dry bulk, right? Because there are three major areas in shipping: is containers that move container boxes, and it's mainly consumer goods. The second is dry bulk that transports commodities. And the third thing is oil tankers that obviously transport crude oil. But if you see in the crude oil market, you don't have the same dynamic, because this area hasn't really been affected so much by the pandemic. So the logistical of the chain is a mess today. What people were used for the last decades is totally out of whack. And it's very difficult to bring that back into some type of a normalization, at least in the next several months. So I think what's happening today with freight rates is going to be with us for quite some time. Again, impossible to put a number to that, but it would definitely be months and quarters. Eventually, the system will normalize because price tends to find a way to normalize these things. But for the next several quarters, I think you're going to have a very high price in terms of transporting goods around the world, especially when it comes to containers and dry bulk.
That is interesting because now the global economies are recovering from the pandemic, and this recovery has been very uneven. Some countries will recover much faster than some others. The countries which have accelerating vaccine rollout in particular. So what is your outlook for the global shipping industry in 2021, particularly given this uneven global economic recovery?
Yeah, I think shipping is an industry that is very levered to economic growth. Again, you're talking about transporting goods, whether that's consumer goods or commodities around the world. And when demand increases because economic growth is strong, shipping is a major beneficiary of that. And a great example is what's happening today. It is very cyclical, so eventually, you will see this cycle easing a bit as we go to next year. But I think for this year, the outlook is quite promising. Already, you've seen very strong signs of that, and that's obviously a very cyclical trend, and it has to do with this fast acceleration in economic growth, especially in the Western world. As you mentioned, this is an uneven recovery because countries like Brazil or India are still suffering massively from the pandemic. So this is not across every region, but in reality, the Western world has always been the major consumer in the globe, and right now they are basically trying to restock. After the pandemic, to buy goods, to buy commodities. To start the production lines back, whether that's making cars or making household appliances, and of course every consumer good, and that is putting a lot of pressure on freight rates, and that's what's happening today. I mean, if you look at dry bulk, you're looking at freight rates at 11-year highs. In containers, as you mentioned, you're approaching basically the late 2000 record higher rates. I don't, unless obviously a lot of things can happen, and you might have another wave, and you might have some type of an external event. But as you stand today, and you look for the rest of the year, the outlook for shipping for containers and dry bulk looks quite promising.
So higher shipping costs obviously mean higher prices for consumers because those costs would be passed along to consumers, and that would in turn result in higher inflation. And we have already seen inflation rising. We have seen prices of commodities rising, prices of grains rising, lumber has been soaring. Now, looking backwards, do you think that investing in shipping, like shipping companies or freight futures, they can be a good inflation hedge? Do you think that those profits are likely to increase when inflation also rises?
I think that history tells us that freight rates are a levered play on inflation, and it's easy to see why. I mean, the price of freight, the cost of transporting something, is embedded in the price of the actual good. I will give you an example. Iron ore, which most of the people, are not familiar with, is one of the most tradable commodities in the world. Actually, it's the second after crude oil. In the Western world, it's not very popular, or it's not around, because obviously the construction and the steel industry is past the cycle, which peaked sometimes in the 60s. But if you look at the Asian economies, this is still very much alive. And iron ore is basically the material that you use to make steel. Iron ore prices have basically doubled in the last year. This is not so much because of the reopening of the economies, but it's very specific reasons behind it for the iron ore market. However, the cost of transporting iron ore, even if it has doubled, it remains a lower percentage of the cost of iron ore because it's such a small percentage of the delivery price that even if freight doubles, it doesn't really affect so much the delivery price of iron ore. And this is happening to a lot of other commodities. Let's take, for example, corn, which obviously had a very strong performance. It has doubled, I think, since last year. Again, if you look at the percentage of freight in the delivery price of corn to, let's say, China, again, it's not a big, meaningful percentage of the overall price. So freight has the ability to actually, move much more than the underlying commodity. And that's why I'm saying it's a lever play on the commodity cycle. Now, a lot of people consider commodities as a hedge against inflation. And I think that historically that actually has been the case. So if you're looking for something with an added boost to that, that's definitely the price of freight. So I would agree with your comment. I think freight is a very easy and efficient way to protect yourself against inflation. And if you look at the Baltic Dry Index, which is a very well-known index in shipping, it has actually tracked global inflation. Again, that's not only for the US or for the Western economies, it's more global. It has tracked actually over time global inflation very, very closely.
Very interesting. Now let's talk about the shipping ETF. It is, again, the Breakwave Dry Bulk Shipping ETF, ticker symbol BDRY, the best performing ETF this year. And you partnered with ETFMG to create this ETF. Tell us more about this ETF, what exactly it holds, why you decided to create this product, and how is the portfolio constructed?
Absolutely. I mean, I would start with the idea behind it. And again, as I said, shipping is a vital part of the global economy. And up until we created BDRY, there wasn't really much in the public markets to invest in that would actually track and correlate well with the global shipping markets. The only alternative that investors had was basically a handful of very small and micro cap shipping stocks. But as we know, stocks tend to perform sometimes in line with the industry, but sometimes in line with the broader markets. So as an investor, you are not getting a pure exposure to the shipping markets. So the idea behind it is to create a product that tracks the global shipping industry as closely as possible. And that was the inspiration behind BDRY. BDRY is a product that follows freight futures. There is a market like every other commodity market, like let's say the oil futures market, all the grain futures, or the metals futures like gold and copper. There is actually a futures market for the price of freight. So BDRY owns and holds these freight futures. And through BDRY, every investor can actually participate in the freight futures market. As an ETF, you can buy it and sell it as any other stock. And the ETF, as I said, buys and holds these freight futures. So as an investor, you directly participate in the shipping industry without any middleman, without any in between, like, for example, like a shipping equity has when you look at investing in the shipping market. Obviously, I would imagine a very small percentage of investors or people are familiar with freight futures. And I think that has been obviously an issue for us to explain how freight futures work and what they are, let alone the overall dry bulk freight market. But we have been trying to provide as much research as possible and as much commentary as possible around the dry bulk market, which is not a mainstream market, to be honest. But I think it's quite interesting, and it's something that can perform quite well. And I think, as you mentioned, year to date, it has performed extremely well. which for shipping standards is not unusual, by the way. It sounds percentage-wise as a very, very strong performance, and it is. But if you look at past cycles, if you go in the 2000s, for example, freight rates went up like 10, 12-fold. And obviously, it's a cyclical industry, so they came down by the same amount, and then they went back up. It's a very volatile market, but it provides the opportunity to a lot of investors to participate in these cycles. It's not a growth industry; it's a purely cyclical industry. But for someone who wants and have the appetite for this type of risk to participate, BDRY provides them with the opportunity to do so.
Definitely a very interesting and a very unique product. But I noticed that the expense ratio is quite high. It is 3.3% as of now. So tell us why the expense ratio is so high, and also should investors expect a lot of volatility in the performance?
Yeah, so BDRY right now is the most volatile ETF in the market. When you take all the 2,000 plus ETFs, and I'm talking about unlevered ETFs, BDRY by far is the most volatile ETF. When you look at the expense ratio as a percent of the volatility, it's actually one of the lowest products out there. So if you compare your expense ratio versus the expectation of performance that the volatility implies, it's one of the lowest, actually, even for the plain vanilla ETFs. However, the reason for the high expense ratio is the product that BDRY is involved in. The freight futures market does not trade electronically. There is no screen that you can buy and sell. There are no computers that trade freight futures like in every other commodity out there. It is still a traditional market that is a voice brokered, voice traded market. So whenever you want to transact in the freight futures market, you actually have to pick up the phone and make a transaction the old way. Everything is done manually. There is no electronic back office or anything like that. So you actually need actual human beings to transact on that. Transaction cost for freight futures is much higher than any other product out there. Actually, is something like, I think, 20 times more expensive to trade freight futures than a single stock. So it is an expensive market. However, if an investor was able to do so, which is not actually the case today, but if you were able to trade yourself, you have to pay a much higher price actually than even the expense ratio of BDRY, because a lot of the functions that BDRY does have been negotiated in a much lower level given the size and the scope of the ETF. So we think we bring this product at a very attractive price, even if it's relatively high, given the specialty of freight futures in the market.
That makes a lot of sense. Thanks for explaining. And also thanks for joining us today. Really interesting discussion.
Thank you for having me.
Thanks for listening. Make sure to subscribe to our show so that you do not miss any episode. If you like the show, please leave us a rating on iTunes or wherever you get your podcasts. If you have any comments, questions, or suggestions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.